evening, everyone, and welcome. We're honored to be joined by Mr. Hitesh Setia, the Associate Vice President, Commodity Relationships at the National Stock Exchange of India. With over 15 years of experience in the commodity and the financial space, Mr. Setia has been associated with both domestic and the international exchanges. His work spans everything from market development and risk management to advising regulators and the government bodies across the globe. He regularly shares his knowledge at IIMs and has written extensively on derivatives and the financial markets. And today, we're excited to tap into his expertise and unpack its relevance for retail traders and how the NSE is driving innovation in the derivatives market. So over to you, Mr. Hitesh.
Yeah. So thank you, everyone. Thank you, FYERS team, and all the investors who has joined us today uh, in the world of exchange marketplace. We called you as in bottom of the pyramid because retail investors makes the entire pyramid strong. I mean to say the pyramid of financial markets. So thank you so much, and thank you for joining uh, uh, today, giving us an opportunity to share some important and the key updates pertaining to the offerings what we have to the market participants on commodities piece. So in 2018, we got an approval from the regulatory commission to launch commodities derivative segment on NSE's platform, um, uh, because the definition of stock exchanges got changed prior to that, wherein stock exchanges are being even licensed to launch all the other asset classes. So we being uh, the most important player of the financial ecosystem, offering equity derivatives, currency derivatives, securities lending and borrowing, and few other debt instruments, which includes interest rate futures as well. We decided that let us go full-fledged in commodities, but to make systems up and ready, because there is a complete different infrastructure required for commodities. When I say different infrastructure, so I'm just not talking about the tech side of commodity market, which is like non-co-location based connectivity to the exchange systems. I'm actually talking about setting up the entire infra, right, which will serve the physical settlements, which is also called as deliveries in commodities business. Okay, so it took a bit of time for us, but at the end of year 2023, we started our operations after doing a detailed and an extensive research. The research was pertaining to that what is the need of market participants. So I still remember when we were going through the entire data piece of commodities business in India, irrespective of the exchanges offering commodities derivatives, we came to know why are the numbers that approximately 82% of the concentration of volumes in commodity derivatives was towards cash settled products. So there are basically two types of products which are being available in commodity markets. Number one, physically deliverable products. So anything which is easily deliverable, like gold bars, silver bars, metals, and agriculture products. These are easily deliverable products, and easily deliverable products are part of the ecosystem which is pertaining to commodities business, which is physically delivered, not the cash settlement, right? So we have to make the infrastructure ready, but the concentration of volumes since start was towards the cash settled products. So products which are not very much comfortable to get them delivered. Number one, crude oil. You can't deliver. Natural gas. How do you deliver? No one, right? And the electricity futures. These are those three products which are as on date are cash settled in nature. If I go back to a bit of regulations also pertaining to these products, let me tell you there are four type of market participants in commodities market. Number one, hedges, which includes everyone. So from agriculture products, you can also speak about farmer organizations, FPOs जिसको बोलते हैं, um, the physical market participants who are coming and hedging their portfolios or their physical exposure of the spot market to the derivative segment, and a lot of others too. Now, not just this, but let me tell you the perspective which I want to bring home here is that uh, anything which is very hard to get it delivered is part of derivatives, is part of cash settled products. And the regulation pertaining to this also talks about that FPIs, apart from hedgers and speculators, which are financial investors, right? Okay. The financial market participants who are categorized as an FPI are also allowed to participate in Indian commodity derivatives, but only in cash settled products. The underlying product should be the cash settled. That's how the three products which I've just told you, crude oil, natural gas, and recently launched electricity futures, are categorized under that segment, which is called as energy derivative segment. Okay, and they are being offered, they are being used by financial players which are based out of India. So not just you as in financial investors, but there is a participation from global investors, there is a participation from people who are actually using a product, right, in their day-to-day business, right? So the concentration of volume was towards energy derivative segment, which used to account approximately 82% of volume being traded on commodity exchanges. Basis that we moved our focus towards energy derivatives. Under the spectrum of energy derivatives, we found that people actually need and people are more focused towards a stable product. The classic example, when I compare crude oil and natural gas, the more and more stable product in terms of volatility I'm talking about, okay, is crude oil. And that's how we started focusing on crude oil. The next layer of observation, which came out of our extensive research, is that market participants wants to trade options rather than futures, because options even gives a flexibility to a person who is coming with just 50,000 rupees or even 20,000 rupees or even less than that. They can come and participate in options market. Which product? Crude oil options I'm talking about. And people always want to trade a product which is much more stable, because when I compare products like natural gas to crude oil is much more stable. Anything which is much more stable, which never gives or which has almost negligible spikes while trading, always attracts the real market participants like financial investors. That's how from 2023 we started focusing on commodities. Under commodities, we started focusing on energy derivative segment. Under the energy derivative segment, crude oil, and under the crude oil segment, we started focusing on crude oil options. So when we launched, it was exactly a product which was available on the other exchanges, not just in India, but even in globally. If you see, at mid of the month, the crude oil futures contract at the world's biggest exchange, which is a CME Group exchange called as NYMEX, New York Mercantile Exchange, which is now a segment per se of CME Group. Out there, the highest, or the largest amount of trading happens. Their futures contract is exactly aligned today with with the contract which we have launched in 2023, the futures contract. Now coming to the option side, when we launched the options contract, it was exactly a replica contract of the options contract being available in global markets. What was that? A contract which expires 2 days prior to the futures contract expiry date. Let me repeat. 2 दिन पहले फ्यूचर्स कॉन्ट्रैक्ट की एक्सपायरी के 2 दिन पहले the options contract will expire. Even the same concept is out there at NYMEX. We replicate it, right? Okay. In fact, Indian exchanges used to offer the same product. All Indian commodity exchanges used to offer the same, the contract which expires, right? Exactly aligned expiry of global market for futures, and a 2 day prior to it, the options contract expired. Slowly and gradually, people started getting we started getting traction in terms of volumes on the NSE's platform. Slowly and gradually, members started coming, retail participation started happening. But because the same contract of crude oil futures and options was offered was offered by was sorry was offered by other exchange in India as well. That's why, right, the contract attract lesser amount of retail participation, right? Okay. I'm very open in saying this, that we have very less retail participation. Then we thought that let us develop market and try to bring some differential for the product which we are offering. So in the month of November, okay, we changed the expiry date of options contract. Please do remember, everyone who's listening me, we have never changed the expiry date of futures contract. We only changed the expiry date of options contract to create a new difference, and that was based on market feedback being taken from a lot of members and other market participants, and we changed it by 5 more days. So what was the formula? You have an expiry date at the mid of the month for futures, the crude oil futures. A 2 day prior to that, the options contract used to expire. We changed it. We changed it to 7 working days rather than 2 working days. 7 working days, the contract expires for crude oil options. Same underlying futures, no change in underlying futures. So people can always refer to the underlying futures contract chart. Everything remains same, but only the expiry date has been changed. The minute this expiry date got changed, we have seen a 5x increase in retail participation growth. 5x, right? In first expiry, and in second expiry it was 7%, 7x. Tomorrow we have a new expiry date, which is 10th Feb contract expiry of crude oil. And this gives an opportunity to all retail investors connected via FYERS to use this, right, as a great opportunity to trade a cash settled energy derivative product focused to give you a new perspective of a new expiry date under the same spectrum of future contract, which is of crude oil. सेम है, सब कुछ सेम है. इनफैक्ट ऑप्शंस बिल्कुल वही है. ऐसा नहीं है डेट चेंज होने से ऑप्शन चेंज हो गया. नो, यू हैव प्रीमियम्स, you have people trading in the money, at the money, out of money, people buying call option, shorting call option, buying put option, shorting put option, creating debit spreads, creating credit spreads, doing strangles before expiry date, doing straddles before expiry date, doing ratio trading before expiry date. Everything what people are doing in options, in equity derivatives on NSE, the same thing can be applied out here. And people who are more inclined towards looking at charts, right, nothing changes. They can still refer the same underlying chart of NYMEX, New York Mercantile Exchange crude oil chart, right, which drives the Indian prices, right? Same analysis. See, charts are charts. Technical never talks about. I'm not promoting technicals. Yeah, it's an art basically, but I'm just giving you a perspective. The technical never talks about that the applicability of technicals is only on a specific asset class. No, it is agnostic to it. Okay, and people need to realize this. So same futures chart, no change. Use that chart, and you can basis that, use the risk management perspective of trading, and can trade crude oil options available on FYERS platform. And this is 10th Feb expiry contract. The best part, right? The best part is, we are now doing this a day prior to the expiry date, right? Small premiums are being available. So people can do, you know, or take an advantage of smaller premium to trade more aggressively on NSE commodities platform. You can compare our premiums vis-a-vis the premiums being available for the for the crude oil options being offered by another exchange. But because we are close to the expiry, you have all those strikes, which are tradable strike with a strike price differential of 100, with a tick size of 10 paisa, with a lot size of 100 barrels, with the price coming to you or the premium visible to you is of 1 barrel, exactly same, and being available on the exchange platform. What is the best perspective for this product? The best perspective of this product is that, let's say if you are trading options every day in and out, and they're the equity segment, equity derivative segment, it's a super opportunity because after 3:30, right, after 3:30, your amount of margin lying with your member broker, right, is of no use till next day 9:50. Use this platform of NSC commodities, right, that it can help you to generate an extra alpha after 3:30 p.m. If the more you efficiently use your margins or deposits which are lying with FYERS, you can effectively put it in the circle wherein automatically the utilization, right, of these margins makes you more efficient, right? Think through the amount of crores of money is just lying with the member brokers after 3:30, but you as an investor can take use of it near to the expiry. And I'm sure that in last 8 years, what every one of us have learned how to trade expiries. Am I right? Yeah, we have learned this how to trade when you are close to the expiries, right? We had a wonderful product which was a contract which used to expire weekly, which was Bank Nifty. We have the India's most liquid options product, which is Nifty options, again a weekly, right? And we always try to trade something which is close to, when you are near to the expiry or close to the expiry, and that's where we are at, right? A Monday, we are on Monday, we have expiry on Tuesday. The Wednesday the data comes in, so it's an something very good expiry date which is in front of you. I think traders who are listening to me can easily connect, right? How do you make use of this when you don't expect a, you know the ready data points which comes on Wednesday? People can make use of it. Not just the advantage of margin fungibility from one segment to the another, from equity derivatives to commodity derivatives. Let me also tell you the exchange transaction charges, right, is 100 rupee plus GST, which is 118 rupees, 118 rupees are as of date, on 1 crore of premium being traded on NSC's platform in crude oil, right? Just 100 rupees, right? Whereas when you compare the transaction charges of other platforms offering a different expiry date of crude oil, they are 42 times, 42 times I'm talking about, right, more transaction charges applicable on per crore of premium. So think through for a minute that every time when you trade an expiry, every time when you trade a futures contract or an options contract, let me say, right, and throughout the year you trade, with every single drop you save out of the transaction charges, right, every day a small drop. Think through for a minute, we have approximately 240 days, right, of working, right, because on all holidays commodity markets are even working in the second half, right, post 5 p.m. most of, I mean to say, right? Think through that. With all days when you save a small amount of money, this either will add to your profit, which will shoot up your profits, or unfortunately, which could always be a game in the whole system, that if you lost some money, right, you will lose less money because your transaction charges are much lower. Right, I'm telling you very honestly, on from a very honest perspective, that these charges plays a very very vibrant role. And when the underlying product is same, right, you have an exchange offering you one more expiry date. You can even take it like this: one more expiry date for crude, for effective hedging and trading purpose. So you can make better use of your money. You can trade, very very, because you are very close to the expiry date, which is tomorrow, with lesser amount of premiums, right? And you when you trade, you trade on the exchange platform, which is NSE, which offers you absolutely like negligible charges. Absolutely, 42 times we are more cost effective, right? So please make use of this information and trade options just as what you trade equity options day in and out. Absolutely no change, right? Markets are on till 11:55 in night today and tomorrow also, right? So technically, right, you have more than like 30 hours of theta decay remaining, I will say, right? Make use of this information and trade effectively. Do remember, options are made not to just uh, you know trade with naked positions. The word option says that use option, variety, multiple. So try to create positions for today and tomorrow, basis your analysis, basis your risk management, follow the risk management guidelines of options, and make use of strikes, multiple strikes. Do remember, you know uh, uh, after 8 9 years of understanding and knowing options by Indian retail investors, I'm sure that you all know that how to use options more effectively with multiple strikes, rather than just you know being a new investor. You start buying options and selling options very nakedly, right? So you try to create option strategies with a lot of focus, knowing that Wednesday is a great day and a big day in terms of volatility which is going to happen. But today, tomorrow, we have some foreign economic data points coming today in the evening, and some bit of tomorrow, but not great or much. So make use of it. Please do remember, commodity is something which is now the current buzz. If you see what's happening in commodities, what's happened in silver, what is happening, we probably never expected 1 year back that we will see a price so high for precious metals. This talks about that not just equities but commodities should always have to be a part of your portfolio. You never know that when a shift, a bit of shift from equity to commodities can enhance your portfolio and can also reduce your portfolio risk in terms of when you add new asset class, right? Okay, so please make use of this information. Use it now. At FYERS it's available. You are enabled, you're active in commodity segment. You have to just select 10th Feb NSC crude oil options contract from FYERS platform and use it. Please do remember, uh, NSC has just ventured or entered into commodity space, right? I'm giving you something very very important out here, is like the way we have developed Indian equity and F&O business. We will develop commodities. We are coming up with some innovative products like Brent crude oil. We are coming up with thermal coal, 10 gram gold coin, 10 gram gold coin, with a facility to get it delivered at a client location across India, right? Okay, we have that base, being the being the India's biggest exchange, we have that reach per se. We are actually going to come up with something new for the gold in terms when a buyer, if buyer doesn't have a GSTI number, even he can take delivery from NSE's platform, and the delivery can even be given at his home location, at his residence, at his office per se, right? So we are coming up with that. We are also coming up with Indian natural gas contract. We are coming up with Brent crude futures, one of the most widely used futures contract in the globe. So that's what even the plan is. And crude oil option is a small beginning towards it. We have seen a super growth in retail participation. We have seen a substantial increase in FPI participation on our platform. And we have also seen that people got a new expiry date, and that's how a lot of eyeballs are being attracted towards NSE. We also in process of changing the expiry date based on the market feedback for few innovative products which are going to come in future. So that's what our plan is. We will develop surely the Indian commodity markets with you. So that's the end of my part, just to give you a brief about crude oil options. Do remember, it's a 100-barrel contract, expiry date tomorrow, 10 paisa tick size for options and 1 rupee tick size for futures. And the liquidity, if you see on NSE's platform, is towards 100 rupee strike interval. Very detailed, we are close to now 10,000 contracts of open interest, and it is continuously increasing with a lot of volume happening at the money and out of money options, so people can always use of it. That's the end of my part. Happy to answer if there are any questions per se.
Thank you so much, sir. Just a couple of questions. How is the premium for crude oil options calculated on the NSE?
Okay. So there are certain inputs. So this is not just for crude oil. Okay, I want to, everyone who's listening me should understand options premium calculation, or deciding what is the right premium for an option, is basically a formula. And there are different variants to that formula, right? For commodities, it is Black 76 model which is being used. Sorry, I don't want to be sound technical, but um, you need inputs like what is the spot price, which strike price you want to calculate for, how many days are remaining for expiry date, what are the interest rates associated with it, um, and um, any other factor which is influencing, like the calculation pertaining to the volatility, I mean to say. If I have these details, I can put it in the formula, get the exact amount of premium. Just a small thing, say, for example, 5,500 is my spot price. I'm talking about at the money options at 5,500 itself. Time remaining is 1.5 days. I have to be a bit calculative, should not be 2 days, it should have to be adjusted to the number of hours, probably more appropriately saying number of hours being remaining. Interest rate, the market practice I'm talking about is to put zero, because when you take futures price as an underlying price, so future price has inbuilt implied interest rates in it. So why to take interest rates in that formula? And the volatility. Now, volatility is something which is a bit challenging. So you have to look at what is the volatility curve of nearby strikes. Your in the money options, immediate in the money options, or immediate out of money options contract, and between that you have to draw a curve. Let's say your in the money is at 34%, your out of money is 38%. So in between this you have to use a volatility number, uh, basis the historical volatility comparison. Put that number in the formula and you get the exact amount of premium per se. Um, this is a theoretical calculation. There could be some variance, some standard deviation over and above this. But for options buyer who are retailers, should always consider that uh, um, uh, the Greek letter, which is theta dk, which hurts them the most. Please understand the risk associated with theta decay and work appropriately with this. So once you are able to calculate the options premium, you are able to calculate the Greeks. And for option buyers, retailers, the theta decay is something which hurts them a lot. That
Yeah.
needs to be considered on this.
Okay. Now, since you mentioned implied volatility, and since tomorrow is the expiry, how does the implied volatility technically or typically behave in the crude oil options around expiry or around major global events?
Yeah. So first, let me speak about how it behaves when you are close to the expiry date. So the OTM option, see, will always observe a spike in the implied volatility level, something which is probably trading at 72%. A little 400 500 rupees out of money options will have a spike coming to it. So you have usually, not always, but you usually have a curve of which looks something look like a U-shaped curve. Okay. The bottom of that is ATM. So the least implied volatility among all strikes should be and ideally have to be the ATM,
Yeah.
right? And your OTM should have to be higher than ATM strikes, right? And this curve becomes more steep, right, when you are close to the expiry date. So something which is trading, let's say, for example, a 500 rupee above these ATM option is trading at 72%. You will find like tomorrow automatically it becomes 80%. So you have to consider that. That is very, very important. Um, and uh, uh, Before event, uh, uh, the tendency of implied volatility is to increase at the event, at the point of event, right? That is the point where it start, you know, giving the highest spike. I won't say spike, but yes, highest increase. After that it flattens and then start coming down. So you know, a camel hump kind of
Yeah.
structure, you will always observe the highest spike comes when the uncertainty is highest, which is at the point of event.
Okay.
But do remember, to all my friends who are listening me is, we don't have an event today tomorrow,
Yeah.
so very unlikely.
Yeah.
But please use this information whenever you trade any options.
Yeah. Also, what happens if a crude oil option expires in the money on the NSE?
Yeah. So operationally, there's a concept of devolvement, or let me simplify. I don't want to make or confuse people with the word new letter being taught to people. Convert. See, these are not spot options contract. These are option on futures options whose underlying is a futures contract, right? So in the money options contract are converted post expiry. If your strike still remains in the money, right, it gets converted to uh, a futures position. So people will see a futures position, right, post expiry if their strike price remains in the money on expiry date.
Okay.
So all bullish position of options, please note all bullish positions of option, which are buy call and short put, long call and short put, I mean to say, are being converted to long futures position, and all bearish position being created by people, right, short call and long put, right, converted to uh, short futures position next day. So automatically people will be able to see their position basis, you know,
Yeah.
the converted position. And do remember there's an inter cancellation also happens. So for example, I bought a call, I also bought a put, both, you know, went in the money. So I will not have any positions, only a financial settlement will happen.
All right.
So a call to put, a bullish position to bearish position, if both remains in the money, right, they are being automatically cancelled and adjusted with the profit losses.
Okay. All right. Final question, sir. Are crude oil options on the NSE most suitable for hedging or trading? And what kind of retail traders do you think should actually be trading in them?
So see, options is something which is more extensively used by traders for trading purpose, right? Because corporates always prefers to use futures contract being a linear product from their physical exposure perspective. And what was the second question? Sorry, I missed it.
And the second question is basically, is it more suitable for hedging or trading? And what kind of retail traders should use them?
So people uh, at this point in time who are good, right? Because we don't have any great event per se. Great big event is going to happen on Wednesday, which is crude oil inventory data. So I think people who are quite familiar with option concepts of expiry date, number one, number two, with an additional flavor of people using technical charts, because when you don't have an fundamental news coming to the market or any data release coming to the market, you are basically dependent on what has happened in past, right? And use some statistical models. I will simplify it. That's nothing. There's nothing like statistical model. It's nothing but some technical formula, some technical indicator. Indicator is nothing but you're talking about a representation of a statistical outcome of the data, right, on a chart. So people familiar with technical charts, right, can use NSE crude oil options effectively. But please do remember, you're close to the expiry date, so follow all risk management practice, right, for your positions. That means the stop losses effect.
Absolutely. Absolutely, sir. Thank you so much, Mr. Hitesh, for walking us through this fascinating and often misunderstood world of commodity derivatives. The session was incredibly insightful for both beginners and the seasoned market participants. And to all our attendees, thank you for your time and your curiosity. And we hope the session empowers you to explore commodity trading more confidently. So stay tuned for more knowledge-packed webinars from FYERS. Until then, happy learning and smart trading.
Thank you everyone, and thank you to the team of FYERS as well. Thank you. Namaskar.
Thank you.